In 2026, the global airline industry will make more combined profit than ever before in history. $41 billion. Sounds massive. Sounds like the golden age of flying, right? Here's the number airlines hope you never do the math on. That $41 billion spread across every single passenger who flies this year works out to $7.90 per person. That's less than what you paid for the sandwich and the overpriced water bottle before you boarded. So here's the real question. How does an industry that moves 5 billion people a year, that owns some of the most expensive machines ever built, barely scrape together $8 a head? And if it's that brutal, why do billionaires keep buying airlines? By the end of this video, you'll understand this industry better than most people who work in it. Let's get into it. Let's start with the number that fools everyone: revenue. This year, airlines worldwide will pull in over $1.05 trillion. That's more than the GDP of most countries on Earth. But revenue is not profit. It's just the money that walks in the door before the bills show up. And in aviation, the bills show up fast, and they show up before a single passenger even sits down. Here's what most people miss. The biggest fixed costs arrive before takeoff. Before an airline sells one ticket, it has already committed to aircraft financing, insurance, crew training, regulatory certification, airport arrangements. If you're starting a new airline from scratch, you could burn through tens of millions of dollars before a single plane leaves the ground. So that trillion-dollar revenue number, by the time fuel, labor, leases, airport fees, and maintenance take their cut, what's left is a margin so thin it's almost embarrassing: 3.9%. In the history of commercial aviation, industry-wide margins have never crossed 5%. Not once. Compare that to companies like Apple, sitting comfortably above 25% margins some years. Airlines move more people than almost any industry on the planet, and keep less of every dollar than almost any industry on the planet. Here's something most people have never thought about. An empty airline seat is one of the strangest assets in business. If a hotel doesn't sell a room tonight, it can sell that same room tomorrow. The room still exists. The value isn't gone. An airline seat doesn't work that way. The second that cabin door closes, an empty seat is worth exactly zero forever. It cannot be stored. It cannot be resold tomorrow. It's gone the moment the plane pushes back. This single fact explains almost every weird thing you've noticed about airline pricing. The person next to you who paid half what you paid, the prices that spike and crash by the hour, the last-minute deals that appear out of nowhere 2 hours before departure. Airlines are playing a constant, high-stakes game against time because unsold inventory isn't just lost revenue, it's revenue that can never come back. And here's the number that makes this even scarier. Most airlines need somewhere between 75 and 80% of every flight filled just to break even. Read that again. On a typical flight, the first 3/4 of the cabin isn't making the airline money. Those seats exist purely to cover the cost of the plane being in the air at all. Everything after that 75 to 80% mark, that's where the actual profit lives, in the last handful of seats on the plane. Which means one bad month, one geopolitical shock, one fuel spike can flip an airline from profitable to bleeding cash almost overnight. Now here's where this stops being just a business story and becomes a geopolitics story. Fuel is one of the largest costs any airline carries, and fuel isn't set by the airline. It's set by the global oil market, which means an airline's profitability is quietly hostage to OPEC decisions, wars, sanctions, and currency swings happening thousands of miles away from any airport. Airlines know this, so many of them try to protect themselves through something called fuel hedging, essentially locking in a fuel price in advance, like a bet on where oil prices are headed. Here's the twist: hedging can just as easily destroy an airline as save it. If an airline locks in a high price expecting oil to spike, and oil instead crashes, they're stuck paying above market rates for fuel while their competitors buy it cheap. Some of the biggest airline losses in history didn't come from empty planes, they came from a fuel bet that went wrong. So every time you see headlines about tension in the Middle East, a new round of sanctions, or an OPEC production cut, somewhere, an airline's finance department is quietly recalculating whether they'll turn a profit this quarter. This is why airlines aren't really travel companies. They're leveraged bets on global energy markets that happen to also fly people to Bali. Here's a fact that surprises almost everyone. A huge share of the world's commercial aircraft aren't even owned by the airlines flying them. They're leased. Think about that. The core physical asset of the entire business, the actual airplane, is often just being rented month after month from a leasing company or a bank. Why would an airline do this instead of owning outright? Because buying a fleet of aircraft outright requires an almost unthinkable amount of upfront capital. Leasing keeps that capital free to survive downturns, weather crises, and stay flexible. But it comes at a brutal cost. Lease payments don't stop when the planes do. During the pandemic, when planes were grounded worldwide and revenue fell off a cliff, airlines were still on the hook for lease payments on aircraft sitting completely idle on the tarmac. Imagine paying full rent on an apartment you're legally not allowed to walk into. So next time you look up at a plane with a proud airline logo painted across the tail, understand that the logo might be the only thing that airline actually owns. The plane underneath, it may belong entirely to a leasing company or a bank you've never heard of. Now let's talk about something worth more than most aircraft: airport slots. A slot is simply the legal right to take off or land at a specific airport at a specific time. At a small regional airport, that right is basically free. But at the world's busiest hubs, London Heathrow, JFK, Tokyo Haneda, slots are almost impossibly scarce because the runways are already running at full capacity, which means slots become a tradable, insanely valuable asset completely separate from the aircraft themselves. One reported pair of takeoff and landing slots at Heathrow sold for around $75 million. $75 million, not for a plane, not for a fleet, not for a building. For the right to use a runway at a specific time of day. This is why some of the most strategically valuable assets in aviation aren't planes at all. They're pieces of paper granting access to overcrowded skies. An airline that holds prime slots at a major hub is sitting on real estate more valuable than most of its physical fleet, and it's an asset almost impossible for a new competitor to acquire from scratch. Here's the twist that changes how you should think about every airline on Earth. The ticket you buy is often close to a loss leader. The seat gets you in the door. It's not where the real profit lives. The real profit lives in three places most passengers never think about: fees, cargo, and the biggest one, loyalty programs. Let's talk loyalty programs, because this fact alone should change how you see every airline app on your phone. Airlines don't just give out frequent flyer miles out of generosity. They sell those miles in bulk to banks and credit card companies, who then hand them out as rewards to get you to sign up for cards. Every time someone swipes a co-branded airline credit card, the airline is quietly getting paid by the bank, regardless of whether that person ever sets foot on a plane. This turned loyalty programs into something closer to a private currency than a marketing gimmick. During the pandemic, when American Airlines' actual flying business was in crisis, outside analysts valued its AAdvantage loyalty program alone at up to $30 billion, more than the entire airline stock market value at the time. Read that twice. The frequent flyer program was worth more than the airline that created it. So when you're boarding a flight with barely $8 of profit riding on your ticket, remember, the airline may not actually be that worried. They might be making far more money off the mileage points sitting in your account than off the seat you're sitting in. There's one more overlooked profit engine hiding in plain sight: the belly of the plane. Beneath every passenger cabin is cargo space, often carrying freight that has nothing to do with the people sitting above it. And during moments when passenger demand collapses, like the pandemic, cargo has quietly kept entire airlines alive. While passenger seats sat empty, the cargo hold kept flying, kept earning, kept some carriers solvent when ticket sales alone would have sunk them. It's a reminder that an airline's survival often doesn't come from getting better at selling seats. It comes from having multiple, unrelated ways to make money from the same aircraft. Given everything you've just learned, thin margins, leased planes, fuel exposure, brutal break-even points, it should come as no surprise that airline bankruptcies are common. But here's what's strange. In aviation, bankruptcy often isn't the end of the story. Airlines frequently use bankruptcy protection as a tool, not a death sentence, a way to shed crushing debt, renegotiate labor contracts, and reset the balance sheet before re-emerging to fly again. That's part of why some major global carriers have filed for bankruptcy more than once and are still flying today. It's one of the only industries where going broke can be a strategy rather than a failure. Here's a fact that sounds almost conspiratorial, but it's backed by real research. The same handful of giant investment firms often own large stakes in multiple competing airlines at the same time. When the same investors profit, no matter which airline you choose, the incentive for airlines to compete aggressively on price can quietly soften. One-sided analysis found this kind of overlapping ownership can push fares up by 10 to 12% on affected routes, not because airlines are secretly colluding in a room somewhere, but because the entire industry's biggest shareholders benefit more from stability than from a price war. So next time flights on a certain route all seem suspiciously similar in price, this might be part of the reason why. By now the pattern should be obvious. The airline itself might be the worst seat at this table. The companies quietly capturing the best economics in aviation usually aren't the airlines at all. They're the aircraft manufacturers, the leasing companies, the airports collecting landing fees, and the banks selling loyalty points. Aviation is a trillion-dollar industry where almost everyone around the airline is doing better than the airline itself. Which finally answers the question from the start of this video. Why do billionaires keep buying into an industry with margins this thin? Because owning an airline was never really about the 3-9%. It's about national prestige, strategic control over logistics and tourism, and for the smart ones, building the loyalty program, the cargo network, and the slot portfolio around the airline, where the real money has been hiding all along. So next time you're annoyed about a $400 ticket, remember, the airline likely made less than $8 off you. The real business was happening somewhere you never saw, in the lease agreement, in the runway slot, in the miles sitting quietly in your wallet. If you want to keep seeing industries that look glamorous on the outside and completely different once you check the numbers, subscribe. Because next week, we're doing the exact same breakdown on an industry built entirely on the house always winning. The economics of owning a casino. See you there.